Hey everybody, welcome to our DAT IQ weekly market update. This is our update for April 11, 2023. It's episode number 242. It's also the first shipping week of the month and quarter. It's going to be a pivotal quarter for many, assuming the market shows some signs of seasonality. I'm Dean Croak, market analyst here at DAT Freight and Analytics, temporarily sitting in for Ken Adamo. He'll be with us shortly. And I'm joined by special guest today, DAT Data Science Manager, Callie Federer. Good morning, Callie. Welcome to the show.
Good morning, Dean. Thanks for having me.
Yeah. Callie, for those listening, tell us a little bit more about yourself and what you do at DAT.
Yeah, sure. So my background starts in computer science. I did a PhD in computational bioscience. So at the intersection of neuroscience and machine learning, then worked sort of in between academia and industry as a research scientist before switching over to focusing on data science. I've worked in machine learning across education technology, particle accelerators, programmatic advertising, and then now I'm here focusing DAT. Been here about 4 months.
Amazing. You've mentioned like half a dozen words there that I think we need to explore a bit later in the show. Particle accelerators sounds pretty interesting.
Yeah, don't ask too many questions about that. I was focused on the machine learning.
Yeah, it's a fascinating world. I started predictive analytics way back in the early 2000s when it was a whole different field. I don't even think it was a course you could pick at college. So I built some of the first predictive models predicting when drivers had fallen asleep at the wheel, but that was using some really old school technology. Used to take us 3 months to build a predictive model using data. I think you probably do that in about 3 minutes now using data.
They're not always good in 3 minutes, but I think you can build one in about 3 minutes.
Yeah, it's insane. I think 90 days was sort of the minimum table stakes for us back in the early 2000s. Anyway, we'll bring Callie back later in the show after we get through the market update. Ken will probably join us at some point. For those new to the show, remember, we're here every Tuesday at 10 a.m. Eastern, 7 a.m. Pacific, talking about trends in freight. Most importantly, though, we're here to answer your questions. So get those into the chat section as quick as possible. They tend to pile up towards the end. We've got a crew working with them. The long-form version of today's market update will be published this evening, as it always is, on DAT.com. Go to the resources tab and download our weekly blog. You'll see our update for dry van reefer and flatbed, along with a lot of the charts that we'll show you. So with that, let's dive straight into the market update and look at some of the key trends we're watching. Dry van spot rates still looking for the bottom in the market. They slid a little bit further down, penny per mile across the board. Down about 11 cents per mile, though, compared to 2019. They're maintaining that margin above that year. That was sort of a watershed mark for low spot rates in recent times. They're holding that gap, have been for about 4 or 5 weeks. Load to truck ratios, though, slightly higher than this time in 2019 and early 2020. Of course, 2019 was a oversupplied market and very soft demand. On the contract rate side, active contract rates, the average of rates in routing guides, down 1% in the last 2 weeks. Replacement rates, those that are based on RFPs in the last few months, their new rates coming into routing guides used for the first time, down 7% in the last 2 weeks. March imports were out yesterday, according to IHS Market Peers, up 5% month over month. Again, no surprise, this is the time when imports start to increase following the shutdowns in China around Chinese New Year. Long Beach and Los Angeles ports were closed last week. A bit of a surprise. Labour disputes are ongoing. The labour unions still haven't reached an agreement with the port authorities, but this is one of the things that most shippers feared there would be a labour dispute impacting imports. Hence, a lot of shippers in the last 18 months have redirected their freight away from Los Angeles and Long Beach because of possible delays. On the produce front, there are some signs that produce season is starting, although we're off to a rocky start. Strawberry crops facing a 75% loss in California from all of the flooding. Just yesterday, we learned that the peach crop has been almost devastated in Georgia and South Carolina due to the freezing cold in March. So there is some impact on rates in terms of produce season, improving rates in some markets, but we've still got some weather impacts we've got to get through before we can say the produce season is starting and producing meaningful volumes. ACT Research said that the new truck orders for March, even though they were down 10% year over year, are exactly in line with what they thought after a bumper 2022, a very strong end to the year. So there's some catch-up work to do as we go through this year. Let's start with our market update, and let's look at dry van load-to-truck ratios. Volumes are down 19% last week. Again, no surprise. Not unusual following the typical end-of-month and end-of-quarter shipping surge observed during the prior week. More concerning is how close dry van spot market volumes are to this time in 2020, trending about 2% below those volumes for the corresponding week. Load-to-truck ratio down to 1.60 this week, as you can see from the chart, slightly above 2019 levels. In refrigerated, load posts dropped 15% in the last month. Again, no surprise, this time of the year is sort of the slack season. But after being primarily flat for the previous month, carrier equipment posts increased last week by about 2%. Load-to-truck ratio down to 2.60, almost identical to what we observed in 2019 and 2020. In flatbed, March is typically when we see a lot of spot market activity. It often reaches as high as 25% of all loads moved in March. But volumes have been steadily falling in the last week, so we're sort of past that March peak. Volumes are coming down a little bit, but following seasonal trends. Load posts, though, are around 34% higher than this time in 2020. Equipment posts, though, still at very high levels. Load-to-truck ratio on flatbed down 22% last week to 11.27. That's the second lowest in 7 years, only surpassed by 2020 levels. In the market condition index, we're having a little bit of a look at West Coast markets this week, and also some East Coast markets. California, outbound state average rates in California are about 5 cents a mile higher than this time in 2019. Last week's 3 cents a mile increase to $1.82 was the first time rates have increased in California in 5 weeks. In the larger Los Angeles dry van market, volumes are down 5%, but capacity did tighten, which sort of goes against trend of the last month. Rates up 2 cents a mile to $1.55. Los Angeles, Seattle at $2.26. That's excluding fuel. Was 12 cents a mile higher than this time in March. One of the busiest lanes in the spot market on the West Coast, Los Angeles to Stockton. Load volumes were primarily flat, and capacity was also flat at about 250 a mile. That's the lowest, though, in the last 12 months. Loads to Phoenix, another warehouse market that has received higher import volumes over the last 2 years, were also at their lowest in 12 months at 222 a mile. On the East Coast, Elizabeth, New Jersey, capacity tightened slightly, only up a penny per mile to $1.44. That did reverse a 3-week slide. Loads 900 miles south to Atlanta at $1.20. Remember, that's excluding fuel, were the lowest in 12 months. Similar trend for loads from Elizabeth to Columbus, Ohio at $1.32. Other major markets, capacity loosened in Atlanta. Rates dropped 2 cents a mile to $1.64 on 13% lower volume. The same was reported in Chicago. Rates down for the 4th week to $2 a mile, down 3 cents. In the refrigerated market, early signs that produce season will impact national spot rates emerged last week in 2 key markets, California and Florida. Excuse me, for the first time in 5 weeks, outbound line haul rates in California were up 3 cents a mile to a state average of $2.04. That's identical to this time in 2019. In Fresno, volumes were up 8%, making it 4 weeks of gains, reversing the 3-week slide in spot rates. On the East Coast in Florida, produce volumes are increasing. The season is fully underway there, generally peaks around May. Outbound reefer line haul rates jumped 19 cents a mile last week. The outbound reefer rate out of Florida was $1.63. According to the USDA, weekly truckload volumes of produce in Florida are trending about 14% higher year over year. Solid gains reported in Lakeland, the largest produce market in the state. Rates up 15 cents a mile to $1.43. That reversed a 3-week slide in that produce market. Miami outbound rates up 18 cents a mile last week to $1.54. They've been flat for the prior 2 weeks. And in flatbed, similar to dry van and reefer, flatbed capacity was also slightly tighter in California last week at $2.15 for outbound loads. That's also identical to this time in 2019 in that state. Driven by solid gains in Ontario, the state's second largest flatbed market, rates are up for the 4th week, increasing 9 cents a mile to $2.04. In San Francisco, capacity was much tighter, has been for the last month. Following last week's 11 cents per mile increase to $2.49. Volumes are down 7% though, so capacity is tightening there. considerably. Stockton, a nearby flatbed market, was also tight. Rates increased 6 cents a mile to $2.24. In Texas, outbound line haul rates at $2.33 per mile remained the second highest in 7 years, following last week's 1 cent per mile increase. Houston's the largest flatbed market in the state, up 5 cents a mile to $2.41 on 23% lower volume. And wrapping up our market update with the year-over-year look at spot rates, declining spot market volumes and increasing capacity continued the slide in line haul rates down 2 cents a mile last week in dry van, just under 2 cents a mile actually. At $1.66 a mile, spot rates continue to track the closest, with 2019 tracking about 11 cents per mile higher. In refrigerated at $1.98, the national average reefer line haul rate was flat last week. Early season produce volumes in Florida show signs of influencing capacity. National, excuse me, not enough to move the national needle though. Spot rates are about 25% lower than last year, about 11 cents per mile higher than in 2019. And finally, after a solid first quarter, flatbed spot rates have lost ground in the last 2 weeks, following another penny per mile decrease. At $2.17 a mile, the national average is 51 cents a mile lower than this time last year. But about 13 cents per mile lower than in 2018, which was a solid year for flatbed carriers. And with that, it's up to, that's the end of the market update. Remember, you can find out more about what's happening in freight. Just go to dat.com/market update. Our long form version of today's report, along with charts, will be published this evening. And with that, it's over to Ken for the short-term forecast. Yeah, Ken, we can't hear you, so I'm not sure. Your computer update's trashed your volume, I think.
How about now?
There we go.
All right. Sorry about that. I had a Mac update this morning, so
Right.
don't expect that, I guess. But I'm here with y'all now, so good morning. Let's talk some forecasts. So this is our national dry van, is where we start. It's a long haul forecast. It excludes fuel. And for here, we go a little bit more stringent on long haul, so it's 550 miles and above. The blue line is a historical 7-day weighted moving average. I believe we go back to November 1st in this particular chart. And then you have 4 forecast models. You have the red line, which is a short-term forecast. You have the green line, which is a ratecast, as it's in all of our forecasting products. And you have a gray and a yellow, which are blends of the two kind of various mixes, if you will. And you can see there's a whole bunch of disagreement here. The ratecast model is really not seeing any signs of produce season picking up, and a bit of a dip down before we bottom out at that like $1.55 range. Short-term model is really picking up on what should be seasonal produce shipping, retail spring season, and it's just essentially carrying that through the end of the 35-day forecast horizon. So a lot of difference of opinion here, if you will, but we're really going to have to wait to see exactly how things transpire in the next couple of weeks. That should hammer these back into alignment as we get a couple more weeks of actuals. All right, let's get to reefer. A little bit more alignment, but still a bit spicy. So you have the green line again, which is raycast. It's by itself down there, bottoming out. And then the other 3 models have a bit more optimism as we head into the start of May. Let's get to flatbed, and this one's really interesting. So this one has a short-term forecast essentially plotting on that rather linear trend. Then the other models essentially shifted down a bit and rather in alignment, maybe 5 cents off what the other short-term forecast model is predicting. That's where we stand now. Again, I think this is a really formative period for the balance of the year. I know that sounds crazy to think about, but a few weeks in March can say a lot about the entire year. But if we don't start to see volumes and rates pick up here in the next few weeks, I think the needle's going to shift far more towards a 2019-esque year as opposed to a year of recovery. So that's our story, and we're generally sticking to it at the moment. But let's bring Callie on and Dean and go to our question of the week.
Yeah, question of the week, Ken. So really for Callie, what are some of the top areas for data science research in the freight market this year?
Sure. So I'll focus on what are our three top ones. So one of them being rating models, so kind of similar to the forecasting rating models that we just saw, but really trying to zero in on what things can we add to make a better prediction for a specific shipment. So if we know more information about was it hazmat or not, how many pickups, things like that, we can really zone in better on what that rate should be or should have been. Another big area is on search. So when you come on the freight match side and want to find a load or a truck of interest, not just matching based on criteria you set, but trying to really understand, like, beyond what you gave us, what do we know from past search behavior that we think you'll want to see? So really trying to bubble that up higher on your list of items to make it more efficient to find a load, make it more efficient to find a truck. And then third, of course, is fraud. I think fraud has obviously been a hot topic for everybody this year. It's a really difficult problem in machine learning and outside of machine learning, but if we can try to detect it and flag it early, we can try to help narrow down some of that behavior.
Yeah, that's very interesting. So what sort of things would you look at, though, to determine, behavior? Some interesting data points I found in databases that point clearly to human behavior, almost, linking pretty closely to, sort of the psychology of how the brain works. But they're counterintuitive. So, there's not a linear relationship between the two. Sometimes they're very counterintuitive. What sort of things do you find, though, that might be in data, external or internal, that might point to some human behavior traits?
Sure. Oh, do you mean for fraud or for search?
Fraud. I think it's a hot topic. That would be a good one to start with.
Yeah. So I think, there's sort of two ways you can go about fraud detection. I think in some ways it can be kind of a classic classification problem. So in the same one where you might try to classify a dog versus a cat, trying to say, is this good behavior or fraudulent behavior? Well, the reason it's difficult is because you need a lot of examples of fraud. And of course, typically we have a lot more normal behavior than fraud behavior. So the other thing you can do is try and just ask which data points just look different from what we know to be normal. So we might not have classified items that we know are fraud. We can sort of ask, like, if we look in the data, which ones are sort of out of range or out of distribution for our normal behavior. And that can not necessarily tell us for sure that it's fraud or not, but if we can sort of limit for our compliance team what they should look at, it'll make their lives a lot easier, hopefully.
Right.
So, Callie, you didn't come from freight, but you've had the wonderful pleasure of spending the last little bit of your tenure here in the freight industry. What's your initial read? I mean, is this an industry that's ripe for data science to make a big impact over the next few years?
I feel like I don't know what I've been doing not being in this industry for the last 5 years. I think there's so much to be done here. And I think, it really feels like there's so much more utilized data science. And I have not felt that. In other fields, it seems like using data science is sort of a buzzword, and it's become a thing we're trying to throw at every field, whether or not it really needs it. But I actually, being here, it's like, oh, there's so many use cases, so much rich data built up to make such a good use case of data science. But I am super excited to be here.
Yeah, it's fun, right? I mean, so DAT, when I started, had, I think, 4 data scientists and maybe a product manager over analytics. And as of yesterday, I totaled up the department size, and between all of the different analytic disciplines we have, it's over 63 folks working towards these problems. So it's remarkable, the growth that we've seen. And it's not like we have people sitting around idle, right? Everyone's essentially at 100. Yeah. Could probably use a dozen more and keep them busy, right? What problem are you most excited to work on in the next year?
I think fraud is super exciting. It's super difficult. So it's kind of a difficult kind of fun where I'm really excited to try to make an impact in that area in the next year and try to use machine learning to just automate some of the things that a lot of people have to do manually and try to detect fraud. But with that, it's a super hard problem. It's in a lot of data science and machine learning, you're trying to kind of match human intellect on a certain problem. But in fraud, you really have to outsmart people, because as we detect fraud, people will get better at it too. So it's really an interesting race. I think it's going to be a really fun and challenging problem.
What do you think? So when we talk about fraud, right? There's actual, fraud, like cybersecurity kind of fraud, where people have their accounts compromised along with their Match.com passwords and all this other stuff, and they can impersonate someone on various different platforms. But then there's sort of the unpleasant behavior, if you will. How do you differentiate between different types? And like you said, it's a cat and mouse game, but how do you generally compartmentalize all the different venues with which these are cropping up in the industry?
Yeah, without enough labeled cases of each of these types of behavior, I'm not sure you really can. Well, I think probably the best we can do is we can flag anything that looks suspicious, try to narrow down so that a compliance team isn't having to look at every single activity on the app, but they can look at a subset of it. But unless you have really clear labeled of what type of fraud things are, it's really hard to get into that subcategory of different behaviors of fraud. So it'll be more likely that what we would be able to do is just flag things that need more investigation, and then we can continue to grow that data and get some human labels of, okay, what type of behavior was this? Was this actually fraud, or was this just unpleasant or not the right use case of the website?
Yeah, Kelly, often some of the best data predictors come from derived fields where you take existing data points and create a third, but a lot of it comes from that sort of subjective analysis where you might have to study data over time to figure out what the consistency is. I remember with some of the work we did years ago, one of the indicators of credit card fraud was a 99 cents app purchase on iTunes. In terms of credit card fraud, that was an incredibly strong predictor because it was the easiest thing to buy without having to raise any flags. But often that came up when my credit card this was going back probably a decade now, and the predictors have changed. But one of those counterintuitive data points that was turned out to be a very strong predictor over time.
Yeah, the nice thing about using machine learning is that we won't be injecting our own bias for things that when you look at something and it looks normal, but when you can sort of look at this pattern of when that is not actually normal. We can kind of like take a little bit of human bias out of that part.
Yep.
So, Callie, what is the difference between AI and machine learning, and is it an if-then statement? Because I think that's the burning question on everyone's mind just listening to this podcast.
Yeah, I really am careful to not use the words AI. I think it's debatable if we even have AI. I might make some enemies on that. It seems like ChatGPT, of course, is really towing that line. But really, machine learning is the tool, right? It's this set of programming that we're using. Like machine learning, instead of us writing a sequential program to say, if orange and round, then it's an orange, and like coming up with all these rules. Like machine learning lets us just provide a ton of examples and let an algorithm figure out like what makes an orange, what makes an apple. Artificial intelligence is really saying that we have achieved human level intellect in some field. And I think you can argue in really specific use cases that has happened, right? We lose a game of chess, although actually someone just re-won a game of chess against the machine learning algorithm. So maybe the humans are making a comeback after all. But whether or not we really hit artificial intelligence in the broad sense, like the same algorithm that will drive your car will not also beat you at chess, right? So I think that is sort of this, machine learning is a potential path to artificial intelligence, but it is not. I think we use AI a lot because it's good marketing, and it's not always quite the case.
Yeah, I attended this lecture, and it was really fascinating because I never thought about it this way. But basically, like what you're talking about is generalized intelligence, right? Like, will the computers ever reach generalized intelligence? Right. And I never thought about it this way, but the lecturer claimed that the reason, like the roadblock to that, and it's a hard roadblock, is it's a hardware problem, not a software problem, in the sense that the transistors, the circuitry is fixed in a machine and has always been. Human brains are able to actually adapt and change their hardware on the fly. If you think about your brain as a hardware, to think that's essentially the essence of creativity, right? Is to look at something and have a different interpretation of it than someone else and solve a problem creatively. But I don't know. I, for one, welcome our machine overlords, truthfully. I mean,
they'll be so happy to hear that. I think they'll do it kindly with that approach.
But I do think you bring up a really good point, kind of in the little bit of jest we've had here, is that I think if you're listening to this and you're building out some of your own data science or even advanced analytics capabilities, but I think a lot of people get lost in the sauce of is you do need to have really great examples of what good looks like or what success looks like. I've seen so many data science or analytics projects fall flat because it's like, we'll put the latest and greatest Python library or R package against a problem and not really understand, or the data that it's trying to train on isn't clean. And that is just a recipe for disaster when you get down the pipeline, right? Of if it has a fuzzy idea of what good looks like, you're going to get quite a high error rate, right?
And Dean was calling out too that it's so easy to make a model these days that it can be a lot harder to really know what's going on in your model. It's really important to have both pieces, even though there's a lot of packages to automate what we're doing. Doesn't mean it's human understandable or that someone really understands what's going on. The results can look a lot better than they might be.
Yeah, I mean, I'm going to break character a little bit here, and actually, this is not meant as a competitive criticism, but I will point out that there was clearly something going haywire with a different rate forecasting model in the industry. I would think it was like, mid-December, Dean, and the model was showing rates to fall by 80 cents by Christmas, right? And it's like, if you just blindly trust, I would say that you should definitely trust your models, but verify them and sanity check them, because the last thing you want to do is put all your eggs in one basket and then be harming your customers as a result of putting too much trust. How do you blend that, though, Callie? Like, what's your more seasoned approach to verifying and trusting what you've built is behaving accordingly?
Yeah, I think it's a really important collaboration with product that requires that. So product and also industry experts. Like, I think we can use metrics that we know in data science to be good. Like, this is a good error, this is a good accuracy. But you really need that gut check. And of course, you don't want to build a model around a gut check, but you do want to take that really seriously. Someone who knows this industry, someone like Dean, he looks at our forecasting model and thinks something's wrong. Maybe we just don't like where the forecast is going, but maybe something's wrong. And so I think we really need to have a good group of trusted people who both know what they expect things to be and sort of challenge what your model is saying.
All right, last data science question, Dean, before we get to some of the industry stuff, just because I'm geeking out here. But,
one of the things that truckers want to know the most about is what's the probability of it raining after I spend $120 on washing my truck? It's the most asked question, because a lot of them will drop 120, 150 on a truck and trailer only to drive out and into a rainstorm. It's one of the most frustrating things a driver goes through.
Fun thing to see who has good or bad luck, and if you spent that money in your truck, are you increasing the chance of it raining? I don't know. That depends on your luck, I guess.
I actually do have one more question, because I have a very strong opinion of this. So it's a two-part question for Callie. One, do you name your data science models? As like, if you were giving someone advice, would you name your data science models?
I do. I don't know that you should. I think it becomes part of the product and part of the sales pitch. You need to give it a name that people like, that kind of explains what it does, and then you can talk to it to try to motivate it a little bit.
I agree. I mean, I literally did an A/B test where we released a model and made it like a black box, and then kind of re-released it with a name. When I mean a name, it's like, think of Watson, IBM's Watson model, right? And they gave it Matthew Broderick's voice, I believe, when it competed on Jeopardy. But there's this attachment. I actually was reading a piece that suggested that you should onboard your models as the same way you would onboard an employee. So you have a new production model that predicts rates, and you go through the process of scheduling small group sessions and introducing it to the company. And I think there's a hairy edge there of where it gets a little over the top, but people have a general apprehension about relinquishing tasks that they did manually or through experience and acumen to a model. So I really think it's beneficial to put some kitsch around it. Now, once you're really good at it organizationally, do you have to keep doing it? Probably not. But should you name your first big model? Probably. Anything to disagree with there?
No, I think it's good. I think it's a good approach of, you should try to, like, if you're replacing any human manual task with a model, you should be asking the same questions you would ask a human. You should look at the same edge cases, the same examples to make sure things make sense. And I think it could be a much friendlier conversation if you have a name to call it.
Yeah, and always program it to tell you where the bathroom's at, because that's the first thing you need when you're onboarding a new employee. All right, Dean, we have a market question here, moving away from data science.
Yeah, Mark Cash asks, it's a great question. I'm not sure we've got a succinct answer. I'll give it a go though. Large carriers clearly have the ability to survive lower rates by the number of trucks creating revenue. Mark asks, how are small business owner operators, single truck operations going to survive this extreme downturn? How many will go out of business soon? We've been working on a carrier viability index for owner operators in the long haul market, Mark. If I have rates at 212, all in spot rates for dry van and diesel at 411 per gallon, wages at 55 cents a mile, the average operating costs of a long haul truck in our spot market at DAT is about $1.80 a mile. And that based on, that's an average of across the board for insurance and then, maintenance at 14 cents a mile, things like that. That generates a profit of about 7 cents a mile. A year ago, that was more like 57 cents a mile, or maybe back into 2021. So clearly profit margins have come down. Carriers are getting by. The bigger problem, though, is at 7 cents a mile, that's only generating about $7,000 in gross profit per year, which is about the third of the cost of an in-frame engine rebuild, which is inevitable with some of those trucks. If you're a new operator who has paid a lot more for insurance, and for the used truck, then your operating costs are about 15 cents a mile higher. So the answer to the question, Mark, it really depends on how long you've been in the industry, how much equity you've got in your business, and how low your operating costs are in terms of your fuel purchasing ability. I would say to you across the board, though, the average is carriers are getting by, but they're really not generating enough profit to be able to get a return on capital employed or to build enough equity for major repairs. That's the bigger issue they're facing. Of course, that assumes that demand improves in the next month and diesel continues to decrease. They're two unknowns that we're tracking at the moment. So I don't know that we could say there's a severe downturn yet, but that's one of the things that could happen. But for the summary is carriers are getting by at the moment, but barely.
Yeah, I mean, we talk about this a lot, but I'll just reiterate, right? There's a distribution, right? There's no one, we sometimes aren't as careful as we should be around. There are a lot of these point estimates we give around carrier profitability are pretty, wouldn't you say, Dean, a pretty wide distribution. It can vary anywhere plus or minus 20, 30 cents on either side of that distribution.
Yep.
That's one thing to keep in mind. So there are a significant amount of carriers, especially small carriers. But look, large carriers are not absolved from this, but we've seen at least a couple multi-hundred truck fleets go out of business in the last couple months. Yep. So that's one thing to keep in mind. Second thing is we tend to think about these things as all or nothing. So all small carriers are going to go out of business before these are marginal changes. Now, if you're the carrier that's going out of business, this is no comfort to you. But the fact is 3 to 5 percentage point changes in the overall capacity pool have huge impacts to where rates are trending, right? And where the market in general is heading. So while we don't have a specific number, we do suspect that you'll continue to see carrier attrition mainly centered in the small carrier space as long as rates hover where they are now. The question really becomes, does this year shape up like 19 where there is no meaningful seasonality or meaningful uptick in rates? Or do we start to see an upcycle like we've been talking about sometime late in Q2, gaining some steam into Q3 and Q4 with retail peak giving some lift? That's the real question. I think those are the bounds of reality. If we see an extreme banking failure collapse, that's going to throw that into a tailspin. Or if we see a meaningful departure from current estimates of industrial production and consumer spending, it could throw that to the side. But short of that, I think that's what you're looking at from a overall error bound of where the year is going to shape up. Thoughts on that, Dean?
No, I agree. I think there is a range. I've always contended that a lot of the folks that are exposed to the vulnerabilities and the viability of the spot market are those that entered the market in the last upcycle. Talking to some of those carriers now, they are really struggling, especially as they try and absorb higher operating costs from these newer trucks they purchased, or newer used trucks.
Yeah. Before we get to plugs, I'm just going to go on a limb and make a bold statement. We can record this. It's 10:35 on Tuesday, April 11th. Sometime in the next year, rates will go up. And about a year from now, I'll write a nice blog post about how I was totally right about that. But sometime in the next year, rates are going to go up, and it'll be great. But again, we don't know. There's a lot of road between now and what it looks like a year from now. So, all right, move on to plugs.
All right, plugs. Sales chatter tomorrow, 11 a.m. Eastern. I'll be on with Ryan and Jeff Dickinson. Robert Rouse is on Landline Now tomorrow evening, 7 p.m. on Sirius XM. I'll also be on with Jimmy Mack on Radio Nemo, 8 a.m. Eastern this Thursday. You can catch us on channel 146 Road Dog Radio. The current version of Freightvine, the podcast, has Dr. Edward Blanco. Great podcast. He's talking about the retail market. Coming up next on Freightvine is Mark Levinson, author of the book called The Box, How the Shipping Container Made the World Smaller. TIA Capital Ideas is on next week. We'll see you all there. We're sponsoring the Friday night event. It's called Let the Good Times Roll at the Hard Rock Cafe at the Universal City Walk. And with that, it's back to Ken to wrap up the show.
Yeah, I'll be leading an all-you-can-eat nacho party, and then we're going to go get on the Jurassic Park Velocicoaster and all barf. That's kind of the plan for Friday night. But in all seriousness, we're really looking forward to TIA. It should be a blast this year. I was chatting with some of their folks. I think it's like record attendance this year. I don't know. I might be getting the number wrong, so I apologize. I thought it was something north of like 1,800, pushing 2,000 folks that are going to attend. I've personally been to this resort where it's hosted. It's very, very nice. It's right by all that stuff. So it's going to be really, really fun. Great networking. Really great event. I want to thank Callie for joining us. So we have a lot of awesome data. We've got the best data, the most awesome data in the industry, but data does nothing without people. And I'm super excited that we've built, bar none, the best data science and analytics team in the industry. We're doing great things. Callie's team's doing great things. We're growing, and it should be a really fun year. So we'll have her back on periodically to check in on how some of these research projects are going. Does that sound good, Callie?
Sounds good. Thanks for having me.
All right, who do you got in the NBA playoffs? I was going to ask you at the beginning, but now I have to ask you at the end.
You know who I have.
I know. Nuggets?
Nuggets, number one.
Yeah. I'd like to see the Warriors win, but I think it's going to be the Celtics. Your neck of the woods, Dean.
All
right. All right. Have a great week, everyone. I apologize for the technical difficulties. We'll see you at TIA, and be safe out there. Bye.